Well, it is reporting season, and Marcus Bogdan is the fund manager of the Switzer Dividend Growth Fund. A lot of his stocks have actually reported. So let's just see what he's found. Marcus, thanks for joining us.
Thanks, Peter. Good to be here.
So why don't you just kick off by run through some of the companies that are in your portfolio and what's your take on them and what's the dividend news?
The dividend news is very, very good. Collectively, of the companies that have reported so far in the portfolio, dividends are up over 30%. The reporting season started very strongly with CBA and Suncorp delivering a very strong uplift in dividends. Then we've seen also good performances in the telecommunications space, particularly Telstra and Spark. And then today, it's been the consumer staples. Endeavour and Woolworths have reported strong results, and Woolworths reported a good uplift there in dividends as well.
There's also a buyback mentioned as well, which surprised a few people. You know, would your fund benefit from a buyback?
Well, the buyback from Woolworths was expected because it's the proceeds from the Endeavour demerger. And so that will certainly help in terms of reducing share count, and then ultimately that will be attractive to earnings per share going forward. So it's absolutely a net positive for investors.
Okay. Look, going into reporting season, you had, I guess, a certain forecast on what your dividend might be. From what you've seen so far, are you raising what you thought might be the possible dividend?
Yeah, so coming into the 2020 financial reporting season, there was a high expectation around earnings growth and dividend growth. Earnings growth plus 25%. And we've seen that reflected in the portfolio, particularly on the dividends. So we've had good dividend releases. We've had some special dividends, and we've had some buybacks as well. So there is a high level of consciousness among Australian corporates about providing shareholders with continually good dividends. And I think, importantly, they're on sustainable settings as well. You've seen that with the banks. They're more modest payout ratios, but you are seeing the benefit there of earnings recovery.
What's upon a time a fund like yours wouldn't have actually held a company like BHP for dividends, but it's been a great dividend pay in recent times. The revelation that they're changing, they've basically rolled their oil assets into Woodside, they're pursuing potash and all those sorts of things. What's your outlook for BHP's dividend going forward?
Well, I think in recent years, and I think you can take this across each of those big iron ore miners, is there's been an incredible discipline around capital expenditure, about rebuilding the balance sheets there, and being far more focused on shareholder returns. And so as commodity prices have risen, free cash flow has gone up, particularly because they're not spending as much capital. And so that free cash flow is then being delivered back to shareholders through higher dividends. And you're absolutely right. This is in recent terms, this is a new phenomena from the miners of being providers of very, very attractive dividend yields for Australian shareholders. And yes, you are right. They're also pivoting to new businesses, but notwithstanding that, iron ore and copper will still be the core drivers of this business for the foreseeable future. Yes, they're going to spin off the petroleum assets, but that's around 10% of revenue. And additionally, they are moving into potash. But that potash investment of around $5 billion, you won't see any of the benefits of that until around 2027. So it very much still is, and we have to be mindful of, it's around the iron ore markets and the copper markets, and to a lesser extent, nickel going forward. But I do expect that generosity and that focus on shareholder returns will remain with BHP for the foreseeable future.
So does that mean you'll keep BHP with the same relative holding in the portfolio?
Yeah, I mean, we still think that we're going to still get good dividends around BHP, and they have been executing very well.
Okay. Any other either surprise or interesting dividend stories coming out of reporting season, Marcus?
I think more so on the outlook. So in the first half of the reporting season, we did see more earnings beats. We saw stronger dividends. We saw more buybacks. I think more recently, there's been a more cautious tone around guidance, particularly with Australian companies facing into both New South Wales and Victoria. So we'll just need to see how that plays out. But the portfolio is pivoted towards those strong consumer staple or defensive industrial companies like Amcor and Brambles that are still generating very good earnings and very attractive dividends for investors.
Marcus, Bogdan, thanks for joining us.
Thanks very much, Peter. Cheers.